Hey everybody, good evening. Just a brief video here tonight that I wanted to get out just because of the stress and uncertainty in the gold mining market recently. We had another down day today, and I'm not getting a lot of emails, but I feel it myself, so I just wanted to address what's going on, give you some thoughts on what I expect, how to protect yourself, and basically to not sweat this correction too hard. I talked about it in the fall review in September, and even mentioned that I thought the correction could go into November if it was a traditional sort of time and corrective phase in a sector that had gone up so much. And sure enough, that's what it looks like. In fact, I would guess that we're probably another 1 to 3 weeks of this either consolidation or correction. If I had to guess as well, I would say that it feels like the miners are going to go a bit lower before they do turn around in earnest. The good news with that is that if you look at the weekly charts, and I'm going to include a weekly chart on McEwen Mining in this update that you can take a look at. It's got some arrows with some of the points of interest that you'd want to consider. But the weekly charts on the miners, they look great. They look fantastic. You know, they're still well above the 50 and 200-day weekly moving average. We could see sort of a testing of where those averages cross. The indexes could probably flush a little bit below there. And then still, you know, as long as we do get some traction on the downside and it doesn't get out of hand in the next few weeks, then it actually would set up for a very, very nice year-end rally and, you know, new highs in 2017, which I do expect. And so, you know, it's times like this where we get our resolve tested and everybody's wondering, you know, what's going on. I got a phone call today from an elite member who pointed out that a lot of the big brokerage houses are short. They're asking for stock on the miners and paying a good fee to borrow. And my response to that was, you know, those guys can get squeezed too, you know, and they also can change their sentiment very, very fast. And I think it's you know, the bullion banks, if you look at the bullion banks, which are, I think, the dealers that are really the smart money in the metals, they're starting to cover their shorts, and you're seeing the brokers that are starting to go short, and that to me is more of a sign of the end of the correction than anything to fear in terms of you know, that those guys are they're going to lean on the sector and they've got special information. They don't, and you know, a lot of times they're late to the party in terms of the trade on both sides. So it's not anywhere where it's really sticking out decisively, like the brokers are, you know, and the public is too short, the hedge funds are too short to get caught, and that we've gone down quite a bit. I think it's more in just sort of like they could make some money first, and then we'll see things cover a lot quicker at lower prices. But these are just short-term discussions. They're important because, you know, with the mining stocks, they move, you know, and so this is just a reminder as well that you know, we have to roll with this stuff. This is this sector. You know, we can't expect 10 and 50 baggers on junior mining stocks without some serious whipsaws and some serious periods of just having to be patient. Really, you know, this is a bit of a pullback. This is a good pullback since August, but there's going to be periods too where it just gets frustrating because we have to wait. But all these things you got to work through them. You have to plan for them. You have to have your plan in place before these things happen, I think, from a long-term perspective, or you're just going to be one of the weak sisters that gets shaken out when they shake the trees. You know, if we thought that, say we said that, you know, gold was going to new highs by January 15th, and the gold stocks would be at brand new highs, even if that was like, you know, we had a newspaper that showed us that, this type of action is, you know, it's normal. In fact, you could see a real flush, a scary flush that capitulates the sector in the next couple of weeks. That wouldn't surprise me at all. So in anticipation of that possibility, I'm not saying it's going to happen. I'm saying it certainly could. And if I had to make a bet, I think it will. 60-40, maybe 70-30, that's the case. The miners have a way of just, especially in a bull market, they have a way of just not doing that and reversing on us. So that's why you have to kind of protect yourself in both ways. And the best way to do that, it's not to dump your mining stocks. If you've got some big exposure in very liquid names, you can lighten up. If that makes you sleep better at night and you just get a little more clarity on the direction on the upside, and you're willing to, even maybe pay up a little bit to just feel that the market correction, the sector correction is done. That's not the worst thing in the world. That, I would avoid your core positions for that. But, if you're heavy in some trading positions, then there's nothing wrong with doing that. The other way to do it, and I think this is appropriate for everybody that's really heavy in the miners, is when you have periods like this that are concerning in the short term, and you don't want to get, really, really nervous. You want to always envision from where we are today, instead of hoping that it's not going to go down, sit there and think about what your account and your mindset would look like if we got another 20% flush in the next 2 weeks, 3 weeks. Would you get scared out at the bottom, right when it's about to turn? Because if so, then what I'm about to tell you is really important, and you should consider it. And that's simply to buy some of these inverse juiced up ETFs, DUST, DUST, 3x inverse the miners. And so when the miners go down, say GDXJ goes down 5%, DUST is going to go up about 15%. So what's nice about that is that you can actually, you can hedge your complete portfolio, which I'm not going to do that. I'm not going to go net zero or net short, but I will stay net long. But you can, if you wanted to hedge your entire portfolio, you only have to put up a third of the capital in DUST or JDST, which is another one. I usually do DUST. I'm sticking with DUST. But if you wanted to hedge everything, you do a third of it, and it's going to move around the amount of your portfolio. But I would say, if you even put in, like, at least, if you're worried, and you put in a 10%, so if you have 100 grand in the miners and you buy $10,000 worth of DUST, you're covered on really 30% of your portfolio is hedged. So if the miners go down, it's going to be 30% less of a blow. If you wanted to do a little bit more than that, then you put in $20,000 in DUST and you're covered for 60%, or you do somewhere in the middle. But buying 10% of what you have in the miners to have 30% coverage is really, it's a prudent thing to do if you're concerned, and if you're overweighted and you're starting to think, I've got too much of this stuff, or this is killing me. We always used to say sell down to your sleeping level. I think nowadays, because we have products that can do whatever we want to do with the touch of a button, just like buying a stock, we can use these inverse ETFs to our benefit. We don't have to go out and sell. We don't have to sell our illiquid positions in the junior miners. We don't have to worry too much about that. We can just grab these bad boys. So that's a thought, and it's up to you. You got to make that call. It depends on your situation, your risk appetite, your exposure, all that stuff. Just know that just because we think that gold is going a lot higher in time, it doesn't mean that you can't take precautions along the way and just buy a little bit of extra insurance when technically things are looking weak, and they could get weaker before they get better. But if you look at the MUX, what I will say on MUX, on Mueller Mining, one of my top buys, like I said that when I sold some at 490 in the summer, and I bought a lot of that back already in the low threes. But I've still got a little bit of dry powder left from those purchases, and I was just going to roll back into the amount of shares that I sold, but I've got the profit too, so I can actually buy back at these prices almost twice as much as I had. So I very well may do that depending on how low it goes. 285 to $3 on the US MUX. Do the math on the Canadian by multiplying 1.3, 1.33. Um, but 285 to $3, you're going to see on the weekly chart, there's a gap in the chart that's around where it would fill, around 285, 290. There's also a gap on the daily around the same prices. So those gaps in the charts, a lot of times they'll get filled. The other thing about the MUX chart on the weekly is you'll see on the relative strength, it's come down quite a bit. It's not super oversold on the weekly, but it's really cooled off from how overbought it was in the summer. So healthy for the long term, for sure. And if you look at the MACD on the bottom, which is where those bars are that go below the line, they've been, I don't have it in front of me, but we're talking about 7, 8 weeks, something like that. Maybe I can pull it up here while I'm talking. Yeah, so 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of below zero MACD, but still above zero in terms of the trend line. So I think we could see, that, just looking at that alone, my sense is that we'll start to even out and turn up in the 1 to 3 week period. That's my guess. So really looks good on the weekly. Same thing for a lot of the charts that we have for our gold miners. I think you want to use this pullback to grab some McEwen and some of the favorites. And again, just ease in, nibble in. If you get a flush, say we get a big flush, early next week or something, and McEwen goes to 270, 280 really briefly, and it's all down big in one day. Those are the days where I step in more aggressively. It's really contrary action, and you have to train yourself to do that. But that's when I tend to strike more aggressively. If it just keeps petering down, I'll add a piece, and even if I think it's going lower, it doesn't matter. It's about, these are long-term purchases for me. And if I end up getting way overweight, like buy because it goes to 2, I don't think it will, but say it did, it went back to $2, then I would load the boat even bigger. I would get bigger than I had as a position before. And then on the recovery, if it was way oversold and it bounces back, which it always does from an oversold condition, then I would lighten up and make some trading profits for my time. That's basically how I play this stuff. And it would normalize the position, and I would then have a robust position for the long term. Also, let's just talk quickly about TBT. The inverse 20-year Treasury bond today ripped up quite a bit. I think that we're due for a pullback in TBT. There's a number of signs that are showing that that trade probably won't get away from us, but I think that there's a good chance that the 35-year cycle in bond bull market since 1980-81 ended in July. And that means that if we're going into a rising rate environment going forward, which could last decades, owning something like a TBT is going to do very, very well. And in fact, I look at it as an alternative to some of my cash. We can't get a lot of interest rate in the bank. We can't get it unless we're going to take risk, here and there. But if we have a trend like that that's turning, the returns could be really, really good on my cash in a rising rate environment by being short the 20-year bond. So that's something that I'm not clinging to that I'm not ringing the bell and saying it was definitely the lows, but the way to play that is, let it cool off a little bit, start buying some, and if the rates, I think it was 2.1 was the low in July, if that breaks below there, then you sell the TBT because it's not done yet. That's the way to play it. It limits the downside risk. You don't have to hope and hope and hope, for another 5 years if it's not done. Because frankly, who knows? I mean, it's way overdue for a turn. People thought 5 years ago, 10 years ago, that the bond bubble should burst. But it will. Eventually, rates are going to have to go higher. They're low for so long, they have to go higher. But look at the mess that the central banks are in. The United States Central Bank The Fed is really between the rock and a hard place. We're looking at 8 years since the last recession. A recession will come sooner than later. I don't know if it's like imminent or if it's going to be the record, the longest record ever between recessions, and we go a decade. But it's normal to have a recessionary lull to clean out the system. This isn't a normal environment. There's no question. It's very, very skewed and manipulated with lower rates. But I think they're going to raise in December, and they're going to continue to tiptoe higher, because when that recessionary the economic weakness comes, how are they going to stimulate? If you're at quarter basis point, half a percent, 0.75%, the difference from 2008, 2009 is they could start to cut from, I don't know if it was 5 or 6% yield. So they cut and cut and cut and cut, and they had a lot of ammunition. Now there's no room. So what's the answer? It's NERP, negative interest rates. We could end up joining the club with Japan and parts of Europe. I'll tell you what, that's going to be, if that happens though, it is extremely bullish for gold, because look at the opportunity with your cash. I mean, if you're paying the government to hold your money, or you could put it in gold, a long-term store of value, what are you going to do? It will attract more and more money into the very small gold market. And so we'll see. But we could see that July was the low. I think TBT is a good speculation in terms of that possibility. SRTY, the short ETF that I've got, as a hedge against, not even a hedge, because I don't have a lot of exposure in general stocks. But if you do, it's the same concept as buying some dust against your mining stocks. Going ahead and buying SRTY if you don't want to liquidate your general securities. You own Amazon, Apple, Alphabet, Tesla, and you think that those are really secure long-term holds. There's going to come a time in a bad market, those stocks that I just rattled off, they will go down to at least 40%. At least 40%. And then in the normal recession, the stock market declines by at least 40% on average. And that's going to be the case for those plays. And they could even be more aggressively declining, because they've been such darlings. It's just the way things work. So I think it's a good time to just have some insurance out there. I don't know why, but I've got it's a little skittish feeling after this election. Who knows, man? It's a crazy world out there. I'm glad I've got a lot of gold. I'm glad that I've got some shorts on the books, and I'm glad that I own a ton of gold and silver miners, and some TBT and some uncharacteristic, uncorrelated investments like Mediatrix and things of this nature that are really, really appealing. Lastly, I will say that Timberline Resources, which has been doing great for us. I've been pounding the table since it was 11 cents. It's at 50 cents now, TLRS. TBR on the Canadian is probably, I didn't check it today, but around 65 cents. And this is what I was looking for. We had the Waterton stock was cleaned out around 40 cents, and there's no more selling pressure. So any new buying, and the company's been on the road talking to new investors. They have a very cheap valuation compared to gold in the ground in Nevada, terrific asset base. And so what's going to happen? It's going to drift up. And I don't think that Timberline is going to see a tremendous amount of selling again or resistance until $1. So, there's still room to go in a Timberline. I think subscribers that don't have any, if we get a little weakness again in a flush in the miners or a weak mining market the next few weeks, it's not too late to buy that stock. I won't want to, chase it forever. I think it's going to go to like $2 to $5 in the bull cycle, at least. So there's definitely room, and it's just it's one of those stories that's going to get out, and there's not a lot of stock and not a lot of supply out there in the marketplace. It's either going to be $1 or not until like early next year, when some of the private placement stock that we invested in the summer starts to become free trading, and people are locking in 5, 6, 7 times their money returns in a 6-month period. So word to the wise there with some of these small deals. I pound the table occasionally, and sometimes I'm not right on with the timing, but a lot of times we are. And with Timberline, I just knew that we were privy to watching this thing and being active when nobody else was. And so this is it's a perspective issue as well. If you want to take a position in something, say somebody had bought some Timberline at 40 cents earlier in the summer, or in September, and then it dipped back down into the high 20s or 30 cents, I think, once. And that's when I was saying it was a buy, and we had the stock showing up from Waterton. So some people, if you don't have a long enough term perspective, or you don't, want to take advantage of the circumstances, people would say, why is the stock going down and what's happening? People that wanted to take advantage of that block that was for sale and increase your position, because if somebody wants to take a big position in some of these small juniors, you got to pay up to shake out stock in a lot of cases. And with Timberline, it was waiting there for us to buy it. So if you were willing to scoop that up and take advantage of the dip, you knew that it was going to get cleaned out and there wasn't a lot of money. It was just going to take a few weeks with the low volume, and then it's off to the races. So it just comes down to, sometimes it's a blessing when things go down, because do you own enough to get really rich from what you hold today? If you are a person who has substantial means and you own like a gold stock or two and you like watching it, it's markets right now with these retracements that are way off the highs. It's your time to take your position and take positions and start buying and building a portfolio and get exposure where, if gold stocks are going to go up another 3-fold and some of these juniors are going to skyrocket 10, 20, 50 times from where they're trading today, then you don't get those type of returns by waiting for everything to turn around and then chasing them higher like everybody else is going to do. You have to take some action now. And I think that, these are good opportunities to buy. And it's like, on the one hand, you could say, I think you get it when I'm walking through this stuff. I'm not speaking through both sides of my mouth. I'm keeping an open mind that the sector could go lower, but that it's a buying opportunity, especially for some people that have not really gotten serious about the sector. So that's it. Long term, we're going a lot higher. We are very, very, very far from any sort of a top in gold and gold mining shares, based on the fact that nobody owns this sector. It got a little bit frothy in August and overbought, no doubt about it. Whenever a sector triples in 8 months, it's got to take a breather and it's got to go lower at some point. So be it. It did it when it did it. But I can tell you from my position, I get to read sentiment and just from an inside basis on this sector with the emails I get and the talks that I have. And I can tell you that all during that rally, a lot of people were waiting for a pullback. We're always worried that it was going to end. That's what you want to see. They call it climbing a wall of worry. And that's what we'll see along the bull cycle. It will be healthy for the bull cycle to continue. What's going to be unhealthy is at much higher prices when everybody's convinced that it's going to continue to go up and that there's no way that gold can go down. That's when we need to be very, very concerned. And frankly, I won't be shy about it. I'll be dumping my positions. I'll be raising cash. And then at some point, I might even just go short gold. The whole gold investment letter might be about shorting the market. That might be in 10 years. It might be in 5, might be in 3. I don't know. But I don't care. I'm not here to just keep pumping gold stocks until we're blue in the face. I'm here to make a ton of money. And you do that by the timing of your actions in the market, having, long-term positions that you're not going to worry about next week or next month. And then also having, if you are inclined to do so, positions where you can take advantage of some of the short-term and intermediate swings, which are very significant in this market. But in any event, it's nothing to worry about, folks. This is the action that we chose. This is the sector that we are in, and it is exciting. It can be a bit painful and worrisome when we get these downdrafts, but it will be much more exciting when we're printing money on the way up and our accounts are skyrocketing like they did in the first part of the year. So hang in there, be smart, don't let your emotions get the best of you, and I will be in touch soon with more information on the markets. Have a great night.